Yesterday, the S&P had its biggest one-day gain since November 2022, and it was up 2.3% at the market close. Now, in today's episode, we are looking at 5 undervalued dividend stocks right there towards their 52-week lows, and the first one we're starting off with is SLB. As we mentioned, this is trading right there at its 52-week low, in fact, and we do get a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Now, this is one with a fairly decent starting yield, 2.5%, and we can see here the forward P sitting at 12.5. Now, if you've been a shareholder over the last year, you would have been down around 25%. Over the last 10 years, not the greatest, as we can see, negative 59. However, if you were to have bought at the COVID lows at around $12, you would be up more than 3 times on your current position. Now, when we talk about this company, it does have a dividend score of 60, so it is borderline safe. Very nice to report that this year, in fact January, they increased that dividend double digits at 10%. And for those that want to know, effectively a borderline safe score means that there is a moderate risk of a dividend cut over a full economic cycle. Now we're going to look through each one's key metric, which highlights how they performed in the last recession, the 07-09 Great Recession in fact, and we can see SLB, they maintained it, they didn't increase it, but they also didn't cut it. They had negative 17% recession sales, which was below the average, S&P at negative 12, and we can see they did marginally trail the S&P, negative 64, the S&P in fact negative 55. Now dividend growth, as we mentioned, nice double-digit increase this year. However, over the last 5 years, they did cut the dividend, hence why the negative 13%. But over the last 20 years, on average, they are increasing it marginally higher than that inflationary target that we have on this channel of 4%. Hence why we do see 2 years of consecutive increases. Now, when we take a look at every company, we want to see what does it tell us on dividend yield theory, and that states a company is undervalued when the current yield sits above the 5-year average. So we have our first undervaluation signal, another undervaluation signal. The forward P sits at 11.5, lower than the 5-year of 18.5. And in fact, on today's episode, a triple undervaluation, as it is lower, although marginally lower, than the sector at 12.2. As always though, we'll never look at any of these in isolation. We will conclude towards the end when we run through the valuation. As always, free cash flow payout, we want below 40% for oil equipment providers. That is if we are being industry specific. Typically though, on the channel, I personally want to see 60% or lower. Just to give us faith, management can offer some nice double-digit increases. And what we have noticed, many years where in fact it has been above, nice to report though, over the last 3 years, around the 40 to 60% level. Over the next 12 months, anticipated to decrease to around 32. So no surprises why we got that double-digit increase this year, and expected a nice increase next year as well. In terms of free cash flow, we do ideally want to see consistent increases over the longer term. Bear in mind though, this is in the oil and gas industry, so we will expect cyclicality to show through the numbers, as we can clearly see here. 2023 though, nice to report, expected over the next 12 months to increase to around 344. Then we move on to the sales growth. As we already mentioned, cyclicality now showing through. 4 of the last 10 years have been negative. Again, nice to see the last 2 years strong double-digit increase, as well as on a trailing 12-month basis. Then when we look at it from a numerical standpoint, again, 49 billion of sales in 2014, down to the lows of 21 at 23 billion, and as we can see over the last few years increasing 35 on a trailing 12-month basis. No surprises with shares outstanding. Whilst we do like to see companies that return excess cash to shareholder pockets through those share buybacks, they have diluted your position, although fairly minimal and trivially over the last 10. We then get to the ROIC, one of our most important metrics. 10% or more is our minimum target. Give us faith, management are able to effectively allocate their capital. Is straddled around that for the majority of the years. We do see some years where it is significantly lower. Again, nice to see over the last 3 years and on the trailing 12 months a very respectable percent. Then we get to the margins. Now, operating side for oil equipment, we want to see 15% or more. Again, very, very inconsistent. Last 2 to 3 years, looking very reasonable, and on a free cash flow margin basis, nice to report across the last 10 years, even though we do see a lot of inconsistency, still at a minimum at that 5% level that we want to see. We then finally draw your attention to another very important metric, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization, below 2.5, and remember, below are the number of years it would take the company to pay off all of their debt net of cash on hand. And why we say this is an important metric, it correlates to dividend safety, balance sheet strength, 0.93 in the more recent year, anticipated to go lower over the next 12 months. So realistically, based on the information we are seeing today, we do believe that dividend is safe. And again, it was very nice to see that double-digit increase in January 24. Now let's get into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value of just over $56. When we do the deeper dives on this channel, we do run through every single one of these models. Today, getting straight to it, at a $56 mark, we always use a margin of safety. Now remember, 10%, we start off with that, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Then we keep going till it's near the current trading price, and what we can see in today's episode, not at a 25% MOS, but at this value of 44, we see it as a minimum 20% margin of safety. Now, bear in mind, Wall Street a lot more bullish. As we said, a strong buy, and in fact, they see upside of 50%. Their price target of $66 is higher than our intrinsic value. So right now, based on our own estimates and judgments, 20% MOS, with Wall Street declaring this a very strong consideration for the portfolio at 50%. We also want to let you know we have released our latest free weekly article. If you want access to this or any other articles, you can grab a copy by clicking on the pinned comment below. And we also have released our August stocks, Undervalued, 35 of them that you can read. A lot of information for each one, and we also go through those that are in our own portfolios. The next stock we're looking at is Essentia, where we do get a double buy rating and a hold from Quant. This one has a yield of 1.63%, a forward P at 26.5, and we can see it does trade in the mid to lower end of the 52-week range. Now, over the last year, your performance would be pretty much flat. Over the last 10 years, it is up 301%, and we can see that would have significantly outperformed the S&P 500. And also bear in mind, this doesn't include dividends reinvested, so that number would be slightly higher. We can also see all-time highs December 2021, $415. So let's talk about this company. Firstly, very safe dividend score at 92. Very nice increase last year of 15%. Always great to see. And what this means, essentially a very safe score. A dividend cut is highly unlikely. Now, last recession, good to know they continued to increase the dividend. They had average growth, and they also outperformed the S&P, negative 31%. Great to see the consistency in the double-digit increases as well, 10% year on year over the last 10 years, and this company has been increasing those dividends for the last 18, so very nice to report. Now, when we take a look at dividend yield theory, we again get that undervaluation signal on the yield, as well as on the forward P, although a very marginal difference at 25.6 versus 26.6. And we do want to point out it is marginally higher than the information technology sector at 24.7. Then we look at the free cash flow payout, where we do want that below 60, remember, and every single year it has been below that, expected to continue over the next 12 months. So in reality, no surprises why in fact we have a very safe score and double-digit increases on a consistent basis. This is beautiful to see. This is what we mean when we say consistent increases to the free cash flow, expected to continue over the next 12 months as well. This is truly one of the most perfect pictures that we could paint about a free cash flow per share looking like an ideal scenario. Then we move on to the sales growth, where we always want to see a minimum of 3 to 7%. Pretty much what we see with Essentia, although some very large increases in 21-22. And when we do zoom out and look at it from a numerical standpoint, they have more than doubled their top line, 30 billion to 64 in 2023. We then move on to the shares outstanding, where we do note some very marginal increases on a year-on-year basis. Again, it is a nice bonus to investors on top of that very nice double-digit dividend growth. Now, ROIC, whilst we do love this, we do have to report it has started to come down year on year. Nonetheless, the last 4 years, as well as a trailing 12-month basis, in the 30% is very, very strong. So this is a great sign that management are able to effectively allocate that capital. Then we talk about the margins, again very strong, above the 12% consistently, and you could argue some very small operating efficiencies, going from 14% to 16% in the more recent period. And free cash flows, again, we do love to see that consistency. And one thing we do talk about from time to time is that companies that do offer that consistency are sometimes worth paying a premium. Now this is absolutely gorgeous as well, nearly zero right across the board, so it does tell us it wouldn't even take Accenture one day to pay off all of their debt net of cash on hand, and anticipated over the next year as well. So what does the valuation tell us? Well, our intrinsic value at $386 is marginally higher than Wall Street. They have a price target of $370, where they see 17% upside. Now, don't forget you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Accenture or any other company. So a 10% margin of safety would be a buy at $347. Then we keep going till it's near the current trading price. Now, it's not at a 20% MOS level just yet. You are getting somewhere between 15 to 20%, with Wall Street, as we can see, believing 17% upside over the next 12 months. And for me, this is one that historically does have some very good metrics, and definitely one to consider, whether it's on the watch list or whether you are considering executing when it does come down to around a 20% MOS level. We then move on to Humana Inc., where we have a buy from Wall Street and a double hold. This one is trading towards the 52-week lows with a yield just above 1%, a forward P around 21.6. S&P right now sits around 23. Over the last year, hammered down around 29%. We have covered this in detail from their earnings report. And over the last 10 years, another one that has outperformed the S&P even after the drop, up 194%. And we can see all-time highs towards the back end of 2022 at $550. Another very safe score at 99, in fact the highest score obtainable. And when we do take a look at those key metrics, well, they didn't pay a dividend, so no comparative data, plus 6%, well above the average. However, they did trail the S&P negative 72. Now, we are waiting for their increase, so the last one was in February 23, but over the last 5 and over the last 10 years, they do historically increase these at a double-digit rate, and that is why we get that 12 years of consecutive increases. Hopefully, we do see an increase this year to take that to 13. Then when we take a look at dividend yield theory, an undervaluation signal on the yield, 1.01, much higher than the 0.68 average, but we do note the forward P around 20 versus the 5-year of 19 is marginally higher, and we can see again higher than healthcare sector as a whole at 16.5. In terms of the free cash flow payout, well, consistently below 60%, 15 in 2023, expected 19 over the next 12 months. So this is one again that we would like to see another double-digit increase to continue that nice streak. Then we talk about the free cash flow per share, $7.07 in 2014, more than tripled to $24 in 2023. Although do note over the next 12 months, this is anticipated to drop to around 18.6. And then when we get to the sales growth, very strong consistently, nearly double digit every single year. And when we look at it from a numerical standpoint, more than doubled, 49 billion to 106. Again, love to see this. Share buybacks on top of a double-digit increase in company, 156 down to 122 over the last 12 months. Maybe not a massive amount, but again, it does increase that ownership that you do hold over the company. And then when we look at the ROIC, very consistently above that minimum 10%, 16% over the last 2 years, 13% as well, looking respectable and reasonable on a trailing 12-month basis. Now, typically for the operating margin, we do want to see it above 12%, but bear in mind when we have reviewed similar companies like UNH, like ELV, they do have a very similar margin, so this seems to be something that is sector-wide, but again, we want to see it around the highs of the 5 to 6%, 4% in 2023, 3% on a trailing 12-month basis, maybe something to incorporate into the margin of safety. Free cash flow margin, well, something that is very inconsistent, straddling around that minimum that we ideally want to see at 5%. And when we get to the net debt to EBITDA, another very strong company with the balance sheet looking excellent, zero right across the board, and over the next 12 months, wouldn't even take them that one day to pay off all of their debt net of cash on hand. Now, our intrinsic value at $400, pretty similar to Wall Street of 401, where they see upside of 15%. Now, looking at our margin of safety then, 10%, it would be a buy up to $360. at 15% around 340, so not quite there yet, maybe one to keep an eye on if that is the level you're expecting to execute, and those that are looking for around 20% around 320. So in today's episode for Humana Inc., between 10 to 15% in terms of the margin of safety, with Wall Street indicating 15% upside over the next 12 months. As always, do give us your thoughts on these stocks as we go through them below. We then move on to the Dividend King, genuine parts company with 50 plus years of increases, double buy signal with the hold from Quant, trading right there towards its 52-week lows with a yield of 2.9% and a forward PE just below 15. Now over the last year it is down around 11%, over the last 10 years though up 63%, with all-time highs sitting around that $190 mark. So let's get to the dividend safety. We got an 80 score, which is safe, and a very recent increase, 5.3%. Remember, above that minimum 4% that we do want to see on the channel. So last recession, while they increased the dividend, they had average growth at -9%, and they marginally outperformed the S&P -46. When we look at the growth, as we said, above inflation this year, again, not too bad over the last 5, and pretty consistent with their increases, around 6% year on year over the last 20. And as we mentioned, a Dividend King, 67 years of consecutive increases, something we do love to see here on this channel. Then when we look at dividend yield theory, an undervaluation on the yield, undervaluation on the forward P, and when we do look at it though, the consumer discretionary does sit marginally lower at 13.2. In terms of the free cash flow payout, while consistently below 60% year on year, something to keep an eye on is over the next 12 months, we get a 132% expectation, which means that management are expected to pay out more in dividends than they will generate in free cash flow, so something that we need to incorporate later on. In terms of the free cash flow per share, increasing over the longer term, it is fairly inconsistent though, so do watch out, and over the next 12 months, it is expected to drop to around 304 per share. Then we talk about sales growth, again at a minimum over the longer term, it is around that 3 to 7% level. We do see a drop in 2020, but it has rebounded sharply over the subsequent 2 years and 5% in 2023. So from a numerical standpoint, we can see it has increased around 50% over the last 10. They also do share buybacks, but again, it is fairly trivial, not very consistent, a small amount that probably won't affect you too much as a shareholder. Then we look at the ROIC, consistently very strong, above 10% year on year, and it is around the 18 to 9% over the last 3. So again, fairly attractive for investors who are considering this company. We then talk about the margins above 12%. Whilst it isn't there, it is consistently around the 6 to 8%. It would be nice though moving forwards, like we want to see from high quality companies, not just to increase their top line, but also their margins. Free cash flow margin as well, pretty much straddling around that 5% that we do want to see. Net debt to EBITDA below 3, remember that is what we want to see. The last few companies have been very strong around 0. Not too bad, GPC 1.61 in 2023, a small increase anticipated over the next 12 months. Then we get into the valuation, another one where our intrinsic value 163 isn't dissimilar from Wall Street at 166, where they see 20% upside. Then in terms of a margin of safety, well, 10%, a buy at 147, at 15%, pretty much at that current trading price. For those that are interested at a 20%, you would need to see it around the $130 mark. So GPC, Dividend King, 15% margin of safety with 20% upside from Wall Street. Definitely one to consider if you are looking for some well-known Dividend Kings in the portfolio. We then move on to Comcast Corporation with a double buy and a hold from Quant. One that is trading in the lower end of the 52-week range, one of the higher yields today at 3.15%, and a forward P of 9.4. Over the last year, not a great performance, down 13%. Over the last 10 years as well, up around 41. We do know all-time highs sitting right there in August 21 at $62. Nice to see a very safe score as well as a strong increase to the dividend this year at 6.9%. When we look at the last recession, they did continue to increase that dividend. They had plus 3% sales above the average, although they did have a near S&P return, negative 52%. Very strong increases to the dividend, 9% over the last 5, and nice double-digit 12% over the last 10. We can also see they have been increasing those dividends for the last 15 years. When we take a look at dividend yield theory, it's a massive undervaluation signal both on the yield as well as the forward PE, and we can see a triple undervaluation signal. It does sit below that communications 11.5 sector. In terms of the free cash flow payout, well, consistently below 60%. Again, I do love to see consistency for very strong metrics for companies. Sometimes, as I mentioned, it can be worth paying a little bit more of a premium. Over the longer term, free cash flow also increasing, moving in the right direction, nearly doubled and anticipated to continue to 345 over the next 12 months. And when we take a look at the sales growth, while we do note 3 to 7% at a bare minimum, we have to point out just in the more recent year that top line was flat at 0%. And also bear in mind, if you incorporate the 4% inflation rate in real terms, you could argue that year it did drop. In terms of numericals though, nearly doubled over the last 10 years, and we can see they have bought back a lot of shares outstanding, in fact more than 1 billion over the last 10 years. Great to see for investors. And then we get to the ROIC, very consistent year on year around the 10% level, so always good to note. And when we look at the margins, whilst it is above that minimum 12%, they have started to decrease, although when they did get to a low of 17% in 2020, we have seen it rebound up 19% in the more recent. Again, would be good to see it continue to go up back to the levels we saw in 2014. Free cash flow margin as well, very consistent above that 10% year on year, when really we want to see minimum 5%. Finally, the net debt to EBITDA below 3 is what we want to see. That is pretty much what we get. 2.51 in 23, expected to go a little bit lower over the next 12 months. So incorporating this with the low free cash flow payout, easy to see why that dividend does look to be very safe. So the intrinsic value today, $52, a little bit higher than Wall Street. Their price forecast of $47 does indicate 21% upside over the next 12 months. And when we do incorporate a margin of safety, well, at 10%, a buy at $47, at 15% at $44, and we can see in today's episode, you are pretty much getting for Comcast Corporation a 25% margin of safety with 21% upside expected from Wall Street. As always though, do let us know your thoughts in the comments below. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to sign up to the free weekly newsletter below. And also, if you're interested, to come and join us in the Patreon where we do talk about our buys and sells. As always, have a great day. We'll see you all on the next one and take care for now.